Let me move quickly to real estate. Last year, I took a look at the volatility of a large index in Canada. This year, I thought I'd try something a little different. There's one manager in Canada that has been buying hard asset real estate for their investors, institutional and individual investors, for a long period of time, and that's Great-West Life. So they run almost $13 billion of real estate. It's a very, very big real estate portfolio. And this is their history, so that's why I chose them, because I could actually go back and look at the data to 1982. The green represents the cash flow. There's never been a year in which they couldn't distribute an income. The lowest income return for any year is 5%, the highest was 11%. But on capital, the price of the real estate, that's different. The capital values go anywhere from a low of 14.5%, so real estate can lose capital value like it did in the early 90s, to a high of 14%. That's the range. But when we look at this comparison to the TSX, some interesting numbers come out. So the first thing is, in the same 30 years, the TSX returned 8.5%, which is a very respectable return before fees, but it had a volatility of 16%. Now, for a lot of you here, the volatility number might not mean much, but the higher this number is, the greater risk you take, the greater chance there is that the market will move either up or down by relatively large amounts. So you try to contain this number, this volatility, as much as you can. For Great-West Life, the return was virtually identical to the TSX, but the volatility was 60% less because of the nature of the investment, the underlying investment they're in, and the fact that a large part of the return comes from rental income. But when we look at the volatility of the income, so let's imagine you're a retired person and you can sort of ignore price swings, but you want to know that you've got some kind of predictability of cash flow. Well, the volatility of the income alone, in the case of Great-West Life, is minimal. It's 1.3%, is a fraction of what the volatility is in publicly traded securities. So that's part of the reason why we're focused in this area. Looking at the U.S. situation, our U.S. investments in real estate are slightly different than they are in Canada. And this is a report by Raymond James going through the housing situation in the U.S. One interesting note they had was that in the U.S., unlike Canada, the housing participation or ownership rate is declining. That's the blue line at the top, while the rental demand is increasing by a huge amount each year. Part of that is driven by demographics. Part of it's driven by the realities of what occurred in the market in the U.S. in 2006. It is still cheaper in the U.S. to rent than to own, and that's part of the reason that this is true, even though the average house price in the U.S. is about 40% less than it is in Canada. So you can imagine what this would look like from a Canadian perspective. Our marketplace, you can't obviously read that. That shows effectively what the rent advantage is in various jurisdictions in the U.S. This map of the southeast of the U.S., the south and southeast of the U.S. is important because when it comes to rent to own, this market is even less expensive than the overall American market. It's 25% cheaper in these environments to rent than to own, which is why we invest in multifamily apartments in this area in particular. They also have better job growth, they have higher earnings, and they have better demographics. For rental, you want relatively young populations who are in just starting work and are quite comfortable with the idea of renting. The other advantages of the U.S., I think, are significant. The U.S. just recently overtook Saudi Arabia as the largest producer of oil and gas liquids combined. Their production in oil, and mainly because of shale, of course, has increased by at least 3.5 million barrels a day just over the last 4 or 5 years. And at the same time, demand has basically not dropped, but flattened in the rest of the world, which is one of the reasons you're seeing the price of oil drop today. And there are some conspiracy theorists, some of them might be actually right, that are saying that the reason the Saudis are still pumping as much oil as they can is because they are working with the U.S. to basically try to get the price of oil down to a level that will hurt the 3 countries that hate the U.S. the most, which are Russia, Venezuela, and Iran. Now, I'm not sure if that's a spy book stuff, but at the end of the day, it's semi-plausible because all of those countries require oil prices to be more than $100 a barrel in order to effectively fund the budgets they have. And in addition, the U.S. has increased natural gas production by 25%, which is why some of our LNG proposals are challenged because of the fact that the U.S. effectively has now a surplus of natural gas they can export and create their own LNG. So in the U.S., we like investing in the U.S. for a lot of reasons. Those are some of them. We like the U.S. dollar exposure. We like the fact that we can acquire multifamily there, although on the West Coast, our focus is commercial and industrial. And down in the U.S., we can buy investments in apartment buildings where the income rate on the building is 2.5% better than the cost of borrowing money. We can't make anything like that work in most major Canadian markets. In terms of the Canadian Spire, I wanted to give you one value added that helps. At least this is one advantage of lower interest rates. So we take a look at the cap rates. The income rate is what we mean by the cap rate on a building versus the mortgage rates. We look to buy assets where we have a chance to upgrade or improve the assets, and Wayman will speak to that in much more detail in a minute. And we also take a look at buildings that have below market rates for rents, so that gives us some upside potential over time. But if we just focus on the cost of mortgages, on the left here, this is the cost of all the mortgages we have in the Spire Canadian Fund weighted for this year. The average mortgage rate is 4.35%. On January, that will drop to 3.85% across the board. So that means we will be able to add $1.3 million of net income to the rental of the Spire LP in Canada because those mortgage rates have dropped and because subsequently we've locked them in for periods between 5 and 7 years. So in summary, before I pass this over to Eric, single-digit returns, low rates, they may be with us for a lot longer than we might like. The real returns of fixed income can be done, but you have to look at credit risk issues and placement of private debt, mortgages, and other asset classes like that. Private equity, in our opinion, should be part of the asset mix. It's an asset class that makes sense and has actually for a long time. And the real estate obviously adds a lot of diversification and cash flow as well. So with that, what I'd like to do is pass it over to Eric. Eric is Managing Director, as has been mentioned, of TorQuest. TorQuest manages more than $1 billion in private equity money and has been doing so for the last 12 years. Eric is very well respected and very knowledgeable in this area. So Eric, can I ask you to come up, please?